Imagine losing hundreds of millions of dollars, not because of a bad business decision, but because of a single cyber attack. That's exactly what happened to Mark Spencer, MS, in April 2025. And it's a chilling reminder that cybersecurity is no longer optional for retailers. It's a matter of survival. This wasn't just an IT problem. It was a full-blown financial and reputational disaster, exposing deep-seated vulnerabilities across the entire retail landscape. But here's where it gets controversial. Was MS truly unprepared, or were they simply unlucky in the face of an increasingly sophisticated threat landscape? The M&S Cyberattack serves as a stark case study in what can go wrong when cybersecurity isn't treated as a top priority. Orchestrated by the notorious ransomware group Scattered Spider, who deployed DragonForce ransomware. The breach resulted in a staggering £300 million operating profit loss, a £1 billion plunge in market capitalization, and a painful 12% drop in share price. These numbers are eye-watering, but they only scratch the surface of the true damage. The attack forced a critical reevaluation of how retailers approach cybersecurity, pushing it from a mere technical consideration to a fundamental pillar of operational stability and responsible environmental, social, and governance (ESG) practices. The anatomy of the MS breach reveals a chain of systemic weaknesses. It all started with a seemingly innocuous social engineering attack, where the perpetrators cleverly impersonated IT support staff. This allowed them to bypass multi-factor authentication, MFA, a security measure many consider ironclad, and disable crucial security protocols. Once inside, they exploited vulnerabilities within Active Directory, escalating their privileges and encrypting VMware ESXi servers. MS's decision to not pay the ransom, while ethically sound, exposed the inherent fragility of their supply chain and customer data systems. Online orders were crippled for 2 long months. Logistics operations were thrown into disarray. And perhaps most damagingly, customer trust was severely eroded. And this is the part most people miss. The attack didn't originate within MS's own systems. It stemmed from a compromised logistics partner, highlighting the interconnected nature of modern retail supply chains and how a weakness in one area can quickly cascade into a full-blown crisis. This underscores a broader trend. Retailers are increasingly vulnerable to third-party risks and the ever-present threat of human error. For investors, the message is crystal clear. Traditional risk management is no longer sufficient to guarantee operational continuity. Cybersecurity must be elevated to a strategic imperative, not treated as an afterthought. The MS breach has fundamentally altered how investors perceive retail equities. Before 2025, cybersecurity was often relegated to the status of a cost center, a necessary evil rather than a value driver. Now it's a critical factor in determining capital allocation. Governments are also taking notice, with the UK's proposed Cybersecurity and Resilience Bill and the EU's NIS2 directive signaling a regulatory push towards mandatory cybersecurity standards. ESG rating agencies are also adapting, reclassifying cybersecurity under the social and governance pillars, with a significant portion, nearly 30%, of retail ESG scores now tied to data protection and incident response capabilities. Investors are now meticulously scrutinizing companies based on several key criteria. Third-party risk management. Are contracts with vendors including robust cybersecurity obligations? Incident response transparency. How quickly and effectively does a company communicate breaches to stakeholders? Regulatory compliance. Is the company adhering to established frameworks like NIST, CSF, and GDPR? The MS case vividly illustrates the financial repercussions of underinvestment in cybersecurity. In the 6 months following the attack, their stock underperformed their peers by a significant 15%, while competitors with strong cybersecurity frameworks experienced inflows from ESG-focused funds. ESG rating agencies are increasingly recognizing cybersecurity as a key differentiator in equity valuations. Consider MSCI's ACWI IMI Global Cybersecurity Index, which tracks companies benefiting from cybersecurity investments. In 2025, this index outperformed the broader market, reflecting a growing understanding that cyber resilience is a strong indicator of sound corporate governance and long-term sustainability. Retailers who proactively integrate cybersecurity into their ESG reporting by disclosing breach response times, third-party audit results, and employee training programs are being rewarded with higher ESG scores and lower capital costs. Conversely, companies with weak governance face reputational damage and potential regulatory penalties. The UK's Information Commissioner's Office, ICO, is already investigating MS for potential GDPR violations, serving as a stark reminder that compliance is no longer optional. So what does this mean for long-term investors? The MS breach signals a fundamental shift in the retail investment landscape. Here's a practical guide to navigating this new reality. 1. Avoid retailers with weak cyber governance. Scrutinize companies that lack comprehensive third-party risk assessments or fail to transparently disclose their breach response protocols. For example, avoid firms with ESG scores below 60% in cybersecurity metrics. 2. Invest in cyber-resilient retailers. Target companies with transparent ESG reporting, immutable backups, meaning data cannot be altered or deleted, and AI-driven threat detection systems. For example, consider retailers like Insert Retailer Name, which recently upgraded its NIST CSF maturity score to 4.0. 3. Monitor regulatory developments. The UK's Cybersecurity and Resilience Bill and the EU's DORA, Digital Operational Resilience Act, will significantly increase compliance costs for companies that are lagging behind. For example, track how Insert Retailer Name is aligning with NIS2 requirements. 4. Diversify across cybersecurity sectors. Invest in companies providing cutting-edge ransomware protection, cloud security solutions, and AI-driven threat intelligence. For example, allocate capital to cybersecurity SaaS providers like CrowdStrike or Microsoft's Azure Security. In conclusion, the M&S Cyberattack serves as a critical wake-up call for the entire retail sector. Cybersecurity is no longer a mere technical issue. It's a fundamental governance imperative that directly impacts ESG scores, regulatory compliance, and ultimately, investor trust. As cyber threats continue to evolve at an alarming pace, investment strategies must adapt accordingly. Retailers who prioritize cybersecurity as a core ESG factor will be best positioned for long-term success, while those who fail to adapt will face escalating costs and significant reputational risks. For investors, the message is clear. In 2025 and beyond, cyber preparedness is the new benchmark for operational continuity. The question is no longer whether to invest in cybersecurity, but how to invest wisely in a world where digital resilience defines corporate survival. What are your thoughts? Do you believe ESG scores accurately reflect a company's cybersecurity posture? Or are there other factors investors should consider? Share your opinions in the comments below.